Welcome to the Deep Dive. We go through the earnings calls, the analyst notes, all of it so you don't have to. Today, we're jumping into Serve Robotics, that's ticker SERV, and their Q3 2025 earnings call from November 12th.
Yeah, and the mission for this one is pretty clear. We need to figure out the truth behind their strategy. I mean, they're building this national interconnected autonomous delivery network. It sounds amazing, but it costs a fortune.
Right, so the core tension is, are they actually pulling it off? Is the operational scale real, or are the financial losses just, way too much to handle?
That's the whole story right there.
Absolutely. And you have to remember, this is a super high beta early revenue play. It's all about physical AI and robotics, a sector that's projected to, quadruple to almost $373 billion by 2034.
Exactly. Serve is trying to plant their flag right in the middle of all that future growth. So, okay, let's start with the Q3 snapshot. It was really a mixed bag. You had these big operational wins on one side and some pretty deep financial misses on the other.
Let's start with the good news then, the top line.
The top line was encouraging, yeah. Total revenue came in at $687,000. That was a slight beat against what the street was expecting and a huge 209% jump compared to this time last year.
And that's tangible proof, right? It shows the robots are out there, they're actually being used. And the mix is interesting, too.
It is. You had $433,000 from fleet services, so actual deliveries, and then $254,000 from software services. And that software piece, that's the long-term high-margin promise. A year ago, it was basically nothing.
Okay, but then there's the bottom line. And that's where the cost of all this scaling really becomes clear.
It really does. GAAP earnings per share was a loss of $1.54. The consensus estimate was for a loss of only $1.37. So that's a big miss, 17 cents per share.
And even the adjusted EPS missed. So this is where it gets fascinating for me, though. The market reaction. After the call, the stock barely moved. It dipped, maybe 2.8% after hours. It closed around $10.18. But the options market was pricing in a massive swing, like over 11%.
And that muted reaction is the key takeaway for you, the investor. It tells you everything. It signals that even with this huge EPS miss, which would normally tank a stock, the market is choosing to focus on the operational story.
They're saying, we get it, you're losing money, just show us you're growing.
Exactly. The narrative, the execution spirit, it's overriding the balance sheet pain, at least for now.
Okay, so let's talk about that pain, because it needs context. We know they're burning cash, but what are they actually buying with it?
Well, the GAAP net loss for the quarter was staggering, $33 million. And adjusted EBITDA was a negative $24.9 million. These are serious startup numbers.
They are massive. And the gross margin, I think that's the sharpest point.
It's the most acute pressure point, for sure. Serve reported a GAAP gross loss of $4.4 million on about $5.1 million in cost of revenue. So a deeply negative gross margin.
Wait, a gross loss. So let's be crystal clear for anyone listening. What does that actually mean in this context?
It means they are literally paying more for the basic costs of a delivery. Charging the robots, maintenance, the tele-op labor, than they're getting in revenue for that delivery.
So they're subsidizing every single order.
Every single one. They are buying market share, they are buying robot miles, they are buying data. They're making a bet that future scale and AI efficiency will completely reverse that.
That really puts it in perspective. And looking at that $33 million loss, most of it was in operating expenses.
Yep. $30.4 million in OPEX. R&D was the biggest chunk, about $13.4 million, followed right behind by G&A at $13.2 million. So they're just pouring capital into the AI, new city launches, and integrating those companies they bought.
And this is a huge, but we have to counterbalance those losses with their liquidity. They are not about to run out of money.
Not at all. That's why they can do this. They ended the quarter with $210 million in cash and securities on the balance sheet.
And then they raised another $100 million in October through a direct offering. So they're sitting on a war chest of over $310 million.
That gives them a very clear runway. It buys them a lot of time to make these operational goals a reality.
Which brings us right to those operational goals. This is where management pitched their whole inflection point thesis.
Right. If you're subsidizing deliveries, you better be showing that scale and utilization are just exploding upwards.
And the big headline number was the 1,000 robot milestone. Management basically said crossing that number changes everything. It's not a pilot anymore. It's a real functioning network.
And the key metric to prove that is utilization. It's not just about building robots. It's about getting them on the street, working. Daily active robots hit 312 in Q3. A year ago, that number was just 59.
That is a massive jump. Almost 5 times as many robots out there generating revenue and, just as importantly, collecting data.
And that's driving density. Delivery volume was up 66% just from the last quarter. And daily supply hours, that's the time robots are actually available for orders, it soared 713% year over year.
An incredible number. And they're spreading this density across the country, right? It's not just one city.
No, they're in 5 full hubs now. They just launched in Chicago, Dallas, Miami, and LA, and that footprint serves over 3,600 restaurants and a population of about 3 million people.
And they're not done for the year. They mentioned more expansions coming. Buckhead in Georgia, Fort Lauderdale, and Alexandria, Virginia. Getting into the D.C. area is a big deal.
It is, but maybe the biggest operational win, the thing that builds the real commercial moat, was the partnership news.
The DoorDash deal.
The DoorDash deal, a new multi-year strategic partnership. This is huge because they already have a deep relationship with Uber Eats.
Right, and this signals that whole multi-platform approach they kept talking about. If you think about it, one robot can now drop off a DoorDash order.
And on the way back, it can seamlessly pick up an order for Uber Eats.
That is the game changer for utilization. It crushes the dead mileage. The time a robot is returning empty, that's how you get your cost per delivery down.
Exactly. And they're locking in the restaurants, too. They added Jersey Mike's, which has over 3,000 locations, and they hinted very strongly that another big national brand is coming soon. This proves the big partners are scaling with them now.
Okay, so let's shift to the tech, because none of this works without it. The whole long-term pitch is this concept of the physical AI flywheel.
And that flywheel is powered by 2 key acquisitions they made. Vayu Robotics for the AI autonomy, and Phantom Auto for the tele-operations.
Explain how those two fit together.
Well, Vayu provides the AI brain, the foundation model that lets the robot navigate complex streets without a human holding its hand. Phantom Auto is like the insurance policy. If a robot gets stuck or if a city requires it, a remote human can instantly and safely take over.
So that lowers the friction of just getting deployed in new cities and keeps regulators happy.
Precisely. So the flywheel goes like this. More miles driven means more data collected. More data leads to smarter AI models from Vayu. Smarter AI means less human intervention needed from Phantom, which lets them expand where they can operate, which drives demand for more robots.
A self-reinforcing loop.
Yeah.
And it's already having an impact on the hardware costs.
A big one. Management said the new Gen 3 robots now cost about 1/3 of what the old Gen 2 robots did. That's thanks to better engineering and the supply chain maturing things like cheaper LiDAR sensors from their partners. That cost reduction is absolutely essential for the long-term vision.
Which brings us to the guidance. This is the number that really defines the stock story right now.
For this year, FY25, they just reiterated over $2.5 million in revenue. That's fine. But all eyes are on 2026.
Because that's where they dropped the bomb.
That's where they said they expect, and I'm quoting here, 10x revenue growth in 2026.
10x. That implies revenue jumping to $25 million or more next year. I mean, that is an astounding target, especially for a company that's still burning cash and has negative gross margins.
It's the ultimate test. Management is betting that all the things we just talked about, the DoorDash deal, the lower robot costs, the density, will all hit a tipping point late this year and early next.
So what's the immediate milestone we should be watching, the proof point?
It's the robot deployment number. They said they expect to deploy their 2,000th robot by mid-December 2025. That's actually ahead of their old schedule.
So that mid-December number is the next big catalyst. If they hit that or beat it, it adds a ton of credibility to that 10x ramp.
It does. And long-term, the CEO is talking about a future with 1 million robots deployed globally. He put a run rate target out there of $60 to $80 million in revenue, but stressed that's, more than a year away.
So this brings us back to the stock price. You've got this incredibly bullish narrative from management about 10x growth, and it's just slamming into the financial reality of cash burn and dilution.
And that tiny 2.8% dip after earnings confirms the market's view. Investors are saying, okay, the operational execution is real. You hit 1,000 robots, you got DoorDash, we see it.
But it's not a de-risking event.
Not even close. It's confirmation that this is a high-risk, high-reward bet. And the stock chart shows that perfectly. Over the last month, Serve is down almost 30%, way underperforming the robotics ETF, BOTZ. But over the last year, it's up over 21%, significantly outperforming BOTZ. It just swings wildly on sentiment and catalysts.
Which brings us to our segment where we explore what this all might mean for trading activity.
And the quick reminder, This is purely for informational and entertainment purposes. It is absolutely not financial advice.
The core idea here is that the market sort of underreacted. It didn't fully price in the massive operational wins versus the financial miss.
Yeah.
And that suggests volatility might be a little low heading into the next big catalyst.
Which is that 2,000 robot deployment milestone in mid-December.
Right. And you have this other ingredient.
Yeah.
A very high short interest. It's sitting at around 26.6% of the float.
And those shorts have been successful. They drove the stock down 29% in October. So the whole trade thesis is built around what happens if SIR beats that mid-December target.
Yeah.
It could trigger a very quantifiable short covering event.
A short squeeze.
A classic short squeeze. So you could look at something like a leveraged volatility play, maybe targeting January 2026 options. You're making a directional bet that a clear operational beat will force those short sellers to buy back their share all at once.
And that forced buying pushes the price up rapidly.
Exactly. It's a high-risk move for sure. If they miss the deployment target, the stock could fall hard. But the setup with that high short interest and a clear near-term catalyst makes the potential for a squeeze very, very attractive.
You're betting on the operational metric, the robot count. Against the crowd, it's only looking at the income statement.
Precisely. So to wrap all this up, Serve Robotics is trading financial caution for speed. They're using their big cash pile to scale this AI flywheel as fast as humanly or robotically possible.
And the key question for you as an investor or just someone watching this space is whether that promised 10x revenue jump in 2026 happens fast enough to offset this massive cash burn.
And I'll leave you with one final thought. The big story here with DoorDash and Uber is utilization. But the real signal, the moment this whole thing transitions from a speculative build-out to a true market disruptor, isn't the robot count.
What is it?
It's the moment in 2026 when Serve can announce that its average cost per delivery has officially dropped below the cost of a human delivery worker. That is the invisible barrier. When they break that, the game changes entirely.
That's the metric, the cost per delivery.
Yeah.
And that's the signal we'll be watching for next quarter.